Okay everyone, welcome to Transparent Trading and this mini course series on trading FX and more specifically Euro US dollar. Now, I've designed this course to go over major forex topic areas that I think will be useful for you to apply in your trading, especially if you're a complete price action trader like me. Now, I don't use any indicators, I just use pure price action with supply and demand concepts along with market structure. This helps keep my charts super clean, just like this, only having important structure lines and supply and demand mapped on. It's so much easier to predict price movements when your charts are not cluttered up with 1,000 support and resistance lines. So in this mini course series then, I'm going to go through simple market structure with a chart example, advanced market structure with a chart example. I'm going to go through multi-time frame structure with a chart example, and supply and demand zones with a chart example. I think going over chart examples is really important with someone talking through the price action as you're learning it. I remember when I was learning, I understood everything on a line chart, but then when it came to the actual candlestick charts, it just made no sense, right? The next topic then is entries and targets, and the last topic will be a full trade walkthrough of a trade that I've recently taken. Now, this trade is published on my Instagram, Transparent Trading Pro, with 100% proof along with every single trade that I take, okay? So that is either a win, a loss, or a break-even trade. I share every single trade that I take. Now, I share every trade that I take with 100% proof because I want to prove to you guys that the way I trade is profitable. How many communities do you know where the mentors post all of their wins and they never ever post their losses, right? There is no point learning concepts and going through the charts with a mentor who is completely unprofitable themselves. It's just not going to work and it's not going to help you, okay? So without further ado then, let's get into the first topic. Now, market structure is the basis for my entire strategy. And if you can master market structure, you're going to be on the right side of the market a lot more often than not. It is the very first thing that I look at whenever I even open my charts, and it is the first thing that I mark on, which lays the foundation for all of my trade ideas. Trust me when I say understanding this is so powerful, and even just mastering market structure will give you an edge over the market. So what is market structure then? Well, market structure are the highs and lows within a market that we can map. It acts as a guide for understanding upward, downward, and sideways movements in price, and it allows us to make sense of candlestick patterns on a price chart. Now, this may be very easy for some of you, but we're going to start off with the complete basics here in this mini course. So this is the most simple of diagrams, and even if you are an absolute beginner, you still probably know what a bullish or bearish trend is. So a bullish trend, seen on the left here, is a series of higher highs and higher lows, whereas a bearish trend, seen on the right here, is a series of lower lows and lower highs. Now, this is a very simplistic way to show market structure, but it really helps us understand it from a basic perspective before we add other layers into the analysis. So I'll just go through these diagrams now to show you. So we start off with price moving upwards, making a high. Price can't go upwards forever, otherwise everyone would be profitable traders, right? So price has to correct and pull back, forming this low. Price then starts moving to the upside again, breaking past that previous high. This creates, as the name suggests, a higher high after a break of structure, because price is trading at a higher point than this previous high after this break of structure, okay? A solid horizontal line on the charts shows where this break of structure occurred, okay? Now, once the break of structure happens, and only once it happens, the higher low is then cemented, okay? So as soon as we get this break of structure, and only as soon as we get this break of structure, we can then look back and find this higher low that is now cemented, okay? So what I mean by this is that before the point of the break of structure, so say we were down here and then we pushed up and we haven't broken structure yet, you can't map this on as the higher low yet, because price could come down, trade below this low that was the previous low, and then push up and break structure to the upside, okay? And if that happens, then your higher low isn't this point here. It's going to be this point here, okay? The higher low is the lowest point that caused the break of structure to the upside, okay? So you can only map on your cemented higher low once we have this break of structure to the upside. And as soon as we do get that break of structure to the upside, we can then map on this higher low and say that this higher low is cemented, okay? Now, a bearish trend then is exactly the same principle as a bullish trend, but it's just a downwards movement, right? So once a low is formed here, we then have a pullback. Price pulls back and then starts pushing lower and breaks past that previous low, creating a lower low. Now, it is only at this point of the break of structure that we can then look back and see where our lower high is, okay? We can then map on where our lower high is formed, which is this point here, because it's the highest point that caused the break of structure to the downside, okay? So price then breaks that structure to the downside and starts pulling back. Then what happens? Price reacts off something here and then breaks structure yet again to the downside. As soon as we get this break of structure, we can then look back to find our lower high and map it on because it is cemented. It has caused a break of structure to the downside and therefore it is cemented, okay? The process then just repeats and repeats in a bearish downtrend, pulls back, breaks structure to the downside. Once we get this break of structure, we can then cement on this lower high here, okay? So a good saying then that I like to use is when we have a break of structure, we expect a pullback. So once we have a bullish break of structure here, okay, we expect a pullback. So we expect at some point price is going to pull back. Just like in the bearish example, once we have this break of structure to the downside, we expect, okay, we expect that at some point price is going to want to pull back. Now, this is because price can't go on forever, right? It has to correct at some point. And so it's really good, it's a really good saying to use to kind of get a directional bias, because if we're here, then we're going to want to target this high here. And if we have broken structure, then we can expect that price is going to want to pull back at some point, okay? So it's very good to get a directional bias. Now, we don't know exactly when it's going to pull back, but we know that it must happen at some point. So we can take messages from the market to indicate when this pullback is likely to occur. Now, I'll go into the greater detail later in the course for this topic area. But what could happen is price could break structure to the upside. We expect a pullback, okay? So price could then start pulling back from here. What could also happen is price could go on for quite a while and then start to pull back. Or what could happen is we could only just break structure and then price can start to pull back and then target and break structure again, okay? So there's quite a few scenarios that can happen, but the main thing to take away from this lesson is that when we have a break of structure, we expect that there's going to be a pullback at some point, okay? So it's all well and good then having picture perfect line graphs like this, but how does it actually look in reality? So this is kind of the reality graphs that I have now drawn. So these graphs show exactly the same concepts of a bullish trend and a bearish trend, but what it kind of usually looks like rather than the picture perfect model of up, down, up, right? So again, we'll start on the left. Price pushes up, creating this high, and then pulls back to this point here. Price then pushes up again, causing a break of structure to the upside. okay? As soon as we have that break of structure, we can then confirm that there is a higher low that is now cemented, okay? So we look back and this is our higher low that is now, this is our higher low that is now cemented. Once we have a break of structure, we can expect a pullback, right? So what happens? Price then starts pulling back on this time frame, okay? So this is more like the type of structure now that you're likely to see on the charts, where price comes down a bit, it goes up a bit, comes down a bit, etc., etc. And then eventually it pushes up and breaks structure to the upside here. So we can then mark on our higher low as it is only confirmed and cemented once we have this break of structure, okay? So as soon as we get this break of structure, we can look for the lowest point that caused that break of structure, which is going to be here, okay? So it's only confirmed and cemented once we have that break of structure. After a break of structure, we expect to pull back on that time frame. Price then starts pulling back and the process just repeats and repeats, okay? So it's exactly the same thing for the bearish example again. Price pushes down, pulls back, forming this high, and then pushes down and breaks that structure to the downside again. As soon as we have this break of structure, we know that there is a lower high that caused that break of structure that is now cemented, okay? So where is that? The lower high is the highest point that caused the break of structure, and that's going to be here, okay? Once we have a break of structure, we can expect a pullback. Price then starts pulling back, okay? And then this is more of a complex example again, where it pushes up a bit, pushes down a bit, pushes up a bit, and then eventually breaks that structure to the downside here. As soon as we get this break of structure, we know that a lower high caused that break of structure to the downside. And a lower high is the highest point that caused the break structure, okay? So we can look back and find where our lower high is now cemented on, which is going to be this point right here, okay? Then what happens? After a break structure, we expect a pullback, and the process just repeats and repeats. And then this, once we get this break structure here, this is then our confirmed and cemented lower high here, okay? So that is kind of the reality of higher highs, higher lows, lower highs, and lower lows. And now I'm just going to go through a very easy way that we can find our lower high and higher low, okay? Because some people get a little bit confused when mapping market structure. So say after this break structure, we have this pullback, and then we get this break of structure here. Some people map on the higher low as this point here, because it's kind of the last impulse leg to the upside, okay? That is incorrect structure mapping, because the higher low is the lowest point that caused the break of structure, okay? Now, luckily, there's a very easy way that we can find where our higher low and our lower high is, and that is just by using the rectangle tool on TradingView. So we have a push up, we have a pullback, and we have a push up, and we have this break of structure. As soon as we have this break of structure, we know that a higher low is cemented, okay? How do we find where that higher low is? Well, we've drawn on our break of structure line, so we can get our rectangle tool from our toolbox, and we can draw it exactly over that break of structure line here, okay? Then to find our higher low, all we have to do is we have to pull this rectangle tool all the way down, okay? Now our higher low is the lowest point that caused the break of structure, okay? So in this rectangle, it's going to be this point here that caused that break of structure to the upside. It is the lowest point that caused the break of structure to the upside, okay? So it's quite easy to find on that simple example here, and now we'll go again on this more complex example. We have a push up, we have a pullback, a complex pullback, and then we have this break of structure to the upside here. How do we find our cemented higher low? Well, we draw on our rectangle tool over our break of structure line, and we pull it all the way down. We then need to find the lowest point at which price is traded at within this rectangle that we have just drawn on, okay? So where is that going to be? Some people may map it here, and that is incorrect, okay? It's not the lowest point within this rectangle. If we look in our rectangle and look for the lowest point at which price traded at, it's going to be this point here, okay? And then we can just pull that across, and that is our higher low. Now it's exactly the same principle for the bearish example. Okay, we have a push down, we have a pullback, and then we have a push down and a break of structure. As soon as we get this break of structure here, we know that a lower high has been cemented and caused that break of structure to the downside, right? Simple stuff. How do we find that lower high? Well, we get our rectangle tool and we draw on a rectangle across our break of structure line. We then pull up our rectangle, right? And we find the highest point, because the lower high is the highest point that caused the break of structure. So we look for the highest point that price traded at within this rectangle. So some people may map it on here, which is incorrect, right? It's not the highest point at which price traded at. This here, this high here, is going to be the lower high because it's the highest point that caused that break of structure to the downside. Okay, process then repeats. What happens? We pull back and then we push down and break structure to the downside. As soon as we get that break of structure, we know that there's a lower high. How do we find it? We draw a rectangle on our break of structure line and we pull it up. Where is the highest point at which price traded at within this rectangle? Well, it's not here. It is this point here, right? It is the highest point that price traded at that caused that break of structure to the downside.